What is the build-up method of business valuation? Well, very similar to the earnings capitalization model, the build-up method of business valuation seeks to take whatever you deem to be the normalized earnings of the company. Generally, these are the adjusted earnings, a weighted average of them over a historical period. But whatever you believe that normalized earnings to be for a given period for the year, you divide that by a capitalization factor. And this division extrapolates over time to say what the value of the company is worth. And it's really that simple. So the hard part is coming up with a capitalization factor. In the build-up method, the way you come up with the capitalization factor focuses on what would be the expected rate of return for this type of venture. So the expected rate of return of the company is generally a combination of several things. The risk-free rate plus an equity risk premium, then a size premium, then a company-specific premium. So what is the risk-free rate of return? It's basically the rate of return you would get from whatever treasury securities are, because that's the most risk-free asset class out there. Then you look at the equity risk premium. Now you can actually look at industry betas. These are put out by trade groups that focus on specific industries that analyze the risk of default of companies within a specific industry class or field. So you can try to pull the betas from there and to identify what the equity risk premium. So you would add that to the risk-free rate. And so risk-free rate plus some premium of return that you'd expect for the amount of risk inherent in this type of business. You would also add some additional rate of return based upon size. A larger company is going to tend to be more secure than a smaller company, so the smaller company may entail greater risk. So you'd add some level of premium there, and then any specific company risk you see, because every company is different. Every company has its own strengths, weaknesses, opportunities, and threats, and those opportunities and threats equate to, those weaknesses and threats equate to risk or potential for risk. So you would also add some company specific premium there. And collectively, whatever you come up with serves as the discount rate or the capitalization factor that you're going to divide that normalized earnings by to come up with the value of the company. So the build-up method, very similar to the earnings capitalization method. You're simply focusing on how you determine the discount rate or the capitalization factor for discounting that normalized cash flow to get an extrapolated company value.